Well, welcome back. And Cantabil Retail is in focus today. If you see, company came out with its Q1 FY25 numbers, wherein revenue was up at 128 crore versus 112 crore last year, which was up 14%. While if you see margins were flat at 31%, and net profit was down around 8%. Now, this was led by higher depreciation and higher tax outgo compared to last year. Well, to discuss the results, I am here joined by Mr. Shivendra Nigam, who is CFO at Cantabil. Welcome to the show. Well, Mr. Nigam, the same store sales growth, if you see, was around 1.2%. While volume growth was at 18%. So I'm assuming the volume growth that you have seen is on the back of new stores that you have added?
Let's look at the stock till then.
Let's look at the stock till then. If you see, the stock is actually buzzing today. It's up almost 4%, and so actually good set of numbers when it comes to on the back of revenue and EBITDA, but margins were flat at 13%, at 31%, but net profit was down. Now maybe the company is going into capex, and this is the reason we are seeing high depreciation, but there was also higher tax outgo compared to the last year, and company is actually going for opening of new stores, and company has also entered into footwear, and also the volume guidance. If you see the volume growth has been good at 18%, and the same store sales growth is not good. It's almost 1.2%. Now, the one reason may be the first quarter is actually very weak for the company, and Q2 may be muted for the company, but from Q3 onwards, because of the wedding season, we may see good uptick in numbers. That's how the history has been. Of course, we need to check out how company will foray or increase its presence into women's wear, because almost 86% of the revenue comes from the men's wear. Now company is actually entering, or rather increasing its presence into women's wear, which was 9% last year, 7 to 8% last year versus 10% this year. Also, company is entering into footwear. We would want to know how company is going to expand into this business. Well, Mr. Nigam, so I was actually speaking about the same store sales growth, which is at 1.2%, while volume growth was 18%. Now, I am assuming this volume growth is on the back of new stores that you have added?
Yeah, total volume growth is 18.5% on the basis of new stores. However, the same store volume growth is also 3.6%, and my overall value growth from same store sales growth is 1.2%. So it's quite pretty satisfying number considering the current muted market demand.
So, if you can guide us about the volume growth for the next year, what are we expecting on the volume side?
So overall same store sales growth, we are expecting approximately in value 4 to 5%. So we have seen a trend in first quarter itself despite muted demand. So overall, we are targeting to grow approximately 15 to 8% in terms of overall sales CAGR growth if I talk about. So same volume is also growing in approximately 15 to 18%.
So, Mr. Nigam, I'm expecting the Q2 will be muted, and you can see an uptick in growth in Q3 considering the wedding season?
Perfectly, yeah. So Q2, July was good for us. July was also on a positive side in terms of same store sales growth. August is slightly on a flatter side, September. So overall marginal in Q2 also we are expecting some marginal growth in some sort of same store sales growth. But definitely Q3 and Q4 is going to be a great one. So overall target for the company is same as of now, 4 to 5% same store sales growth and 15 to 18% overall revenue growth.
So you did talk about revenue growth of 15 to 18%, but what about margins?
We are targeting the same margin. Even in Q1, we have improved our gross margin, which was earlier last year 65%. This is 66%, because we always said for us, gross margin is very important. Same thing, gross margin is being maintained approximately on annual basis 55, 56%. And EBITDA margin, we will be back on track approximately pre-India 17 to 18% and post-India 27, 28% we are expecting for this financial year. So
also, let's talk.
Better.
Please go ahead. Please go ahead.
Yeah, sorry, yeah.
So let's talk about your segmental breakup. So how do you see this women accessories contributing in, say, 2 years from now, because your contribution from all these categories is actually increasing. So how do you see this panning out over the next 2 years?
Same thing. Last year we closed menswear at 83%. Women's wear has shown a growth of 1% from 9 to 10%. And kids has also, and accessories is now is operating approximately 4 to 5%. So going forward, since we are opening separate women's and kids store as well, now we are having operating approximately 40 plus numbers in terms of exclusive women's and kids store. So going forward, this number we are expecting to increase 1 or 2% on an annual basis. So down the line, 2 to 3 years, this 10% category of women's wear as of now should settle somewhere around 14 to 15%.
Okay, and where are the margins higher? Because I assume, please correct me if I'm wrong, women's category and kids category have a higher margin. So considering you increasing your presence into women's category, won't that lead uptick in margins?
No, I think some margins are almost same. Women's and category also having the same margin was the men's category. So when I'm talking on annual basis for overall 55% margin, almost margin in all the categories are same. Whether it's the men's is slightly on a couple of percent higher side than women and kids, and approximately on an annual basis they are operating on a same margin.
Okay, then let's talk about on the geographical front. So I think mostly you are present in the North India, upper side of the India. So in coming time, are we looking to expand in South India?
So as of now, yes, we have been present mostly in North India and Western India also having a strong player. So we are now expanding apart from these two big regions. We are expanding on Central India, like MP. MP we have been aggressive now. So core South, we are not looking as of now for next couple of years, you can say. Then after couple of years, when the new territories will be required, when I'm talking, when we are clearing that more than 1,000 crore revenue by FY27, then we are looking for the South India as well.
Also, you've recently added footwear into your portfolio. Now, I would like to know, how is the response, how many stores do we have currently, and what is the future plan when it comes to footwear section?
So the sell-through, I can say, as per our expectation, it is picking up now, definitely. Now it's a 1 year business now, 6, 7, 8, 1 year business now. So we have been put it initially in the 50 stores existing. Now we are opening the larger stores. Now, as in our earlier commentary, as I said, we are opening the larger store. So most of the larger store, when I'm talking about 1400, 1500 plus size of stores, footwear is there. So approximately 100 stores are serving right now. And going forward, we are looking very good. We are expecting good numbers from footwear as well. So it's doing good now.
And so coming to your stores, so what would be the target at the end of the financial year in terms of stores count, and how many stores do you plan to open this year?
So as of now, by the end of June, we are having approximately 545 stores, 544 to be precise. So same number, 70 to 80 stores on an annual basis we have been adding. So last year we closed at 533 stores. If I'll add 70 to 80 stores, so 600 plus, 610, 615, somewhere around by the end of this financial year. And going forward, same approximately 70, 80 store approximately we are opening year on year basis.
Also now, as a management, where do you aspire to be? Because I mean, do you want to be on the value retail chain aspect, or into premium category? Where do you see Cantabil Retail standing between these two when it comes to maybe 2-3 years down the line?
So if you know, our average selling price is approximately 1,000 rupees, 1,000 plus. So when you're talking about value where 400, 500 rupees of ASP, we are not there. And a very premium brand where we are taking 2,000 rupees plus of the average selling price, we are not there. So we are finally very balanced positioning and positioning ourselves as a mid-premium segment. Obviously, there is a value segment and there is a super premium or a premium segment. So we are positioning ourselves as a mid-premium segment.
Also, when I see your revenue per square feet, that has fallen significantly over the last 2 years, and that is actually, hurting your margins as well. Your plan when it comes to, arrest this decline?
So one thing I would like to clear, there is no decline in terms of margin because of the per square feet sale is being increasing. So as we said, last year we are opening the bigger stores now. My average size was 1200 plus square feet, and last year we opened the size of a 1600 plus square feet because, as explained earlier as well, we are when 1000 square feet the property is available, it's a men's store. When it is approximately 1000 to 1500, it's a men's and ladies, and when it is going beyond 1500 plus store plus square feet of the size, we are opening the family store. So obviously, when the sizes are increasing, theoretically per square feet sale is coming down. At the same time, per square feet operational cost is coming down because rental is my big saving. Till last year, my average rental cost was 120 rupees a square feet. Now last year it is 122 rupees per square feet. My salary is percentage cost. So on theoretically, yes, per square feet sale is coming down, but we are pretty okay because we are opening the bigger stores, which is giving the much better number. So overall, per square feet and per square feet cost is being coming down, but company level EBITDA and margins are not being eroded because of this.
Well, got that. Well, thank you so much, Mr. Nigam, for answering our questions.
Thank you so much, Varsha. Thanks.
Well, that was management of Cantabil. With that, it's a wrap on the small and mid cap show. Lots of news on the other side. Keep watching NDTV Profit.